let's get right into this explainer because we are looking at an absolute earthquake in the markets today. KOSPI falls 5.72%. We are breaking down exactly how a geopolitical headline thousands of miles away managed to completely reprice the entire global AI semiconductor trade in just a matter of hours. There is a lot to unpack here, so let's just jump right in. Now, to help us digest all the incredibly heavy, brutal financial data we're going to go through today, we brought along our little mascot, Loro. Look at that cute face. We're definitely going to need Loro's high energy today because the contrast between this smiling little guy and the sheer severity of the July 24th market crash is, well, it's pretty staggering. So let's look at the actual damage. Negative 5.72%. Let that sink in for a second. That is the exact drop of the KOSPI index in one single trading session. For a major national index to drop that much in one day, that is an absolute brutal capitulation. You have to understand, this wasn't just a bad day at the office. This was a systemic shock to the entire system. The market basically just broke violently downward, falling all the way to 6,690.62. And the panic was so intense that right at 11:23 a.m. Korean Standard Time, the exchange actually had to trigger a sell-side sidecar. That literally means they had to hit the pause button on all program sell orders in the cash market for 5 whole minutes, just to try and stop the bleeding spilling over from the futures market. And the sheer volume of the capital flight, honestly, it's hard to wrap your head around. 3.28 trillion Korean won. That's how much cash equity was completely drained out of the market by foreign net selling. Foreign investors were literally sprinting for the exits at breakneck speed. If you want to visualize the breadth of this panic, just look at the heat map. It was an absolute sea of red. Out of 943 stocks listed on the KOSPI, 585 of them dropped. So this wasn't just isolated to a couple of underperforming companies, it was a massive, sweeping liquidation across almost every sector. But the real question is, what actually triggered all this? Well, to find the catalyst, we actually have to trace the kinetic energy all the way back to the Middle East. The main driver here wasn't some bad earnings report out of Seoul. According to the New York Times, Iran rejected a U.S. ceasefire proposal that had been delivered through the Iraqi prime minister. Basically, Iran refused a temporary setup that would leave control of the Strait of Hormuz unresolved, and they warned of further blockades and attacks if the U.S. struck Tehran. So that dual threat to the Strait of Hormuz and the Bab el-Mandeb Strait, it instantly threw global supply chains into a total panic. Brent crude oil surged 6.62%, smashing right past that psychological barrier to hit $100.69 a barrel. And this right here is exactly where the macroeconomic gears really start turning. Okay, it's like a giant puzzle, so let's break down the exact domino effect. Step 1, oil prices surge because of those geopolitical threats. Step 2, higher energy costs immediately fuel fears of near-term inflation. Step 3, to compensate for that inflation risk, bond yields jump. Specifically, the 10-year Korean government yield spiked to 4.449%. And finally, step 4, which is absolutely crucial, rising yields massively increase the discount rate applied to future earnings. Growth stocks, especially in the tech sector, which are priced on cash flows way out in the future, instantly lose value when that discount rate goes up. And this massive macroeconomic shockwave found a very specific target: Korea's memory suppliers. Now, what makes this so wild is the timing. Literally just hours before this hit, Alphabet had released its Q2 earnings, where they confirmed a jaw-dropping $44.92 billion capital expenditure commitment for AI data centers. I mean, that is a massive demand signal for memory chips, but the geopolitical yield shock completely overshadowed it. So who ended up taking the brunt of this, right? It was Samsung Electronics and SK Hynix. They are Korea's top suppliers for AI data centers. And because they're essentially the ultimate growth stocks in the index, they became the ultimate targets. They ended up absorbing an absolutely staggering 80.1% of all foreign net selling that day. And the price drops? Rapid fire and brutal. SK Hynix plummeted 8.34% and Samsung Electronics dropped 7.59%. Keep in mind, these aren't volatile penny stocks. These are massive, highly capitalized giants. Seeing declines of this magnitude in a single session is basically historic. But wait, because it actually gets worse. As these two heavyweights started falling, it triggered this mechanical doom loop. You see, leveraged ETFs that track the KOSPI have to maintain a fixed multiple of the index's daily return. Since Samsung and SK Hynix make up a combined 51.6% of the KOSPI weight, their massive drop tanked the entire index. To keep their leverage ratios intact, fund managers were algorithmically forced to sell even more of these underlying stocks right before the close. If you think about Ground Zero, Samsung Digital City, it is wild to imagine the sheer financial mechanics actively attacking its stock price. Trust accounts and securities firms that handle the hedging for these ETFs were ruthlessly dumping shares. Together, they net sold 1.38 trillion won of Samsung and SK Hynix in massive program baskets, purely just to rebalance their ETF exposure. The selling literally just created more selling. But if we take a step back and shift our focus away from all that algorithmic panic, we actually start to see some really fascinating hidden signals. This is where we can track exactly where the foreign smart money was pivoting while all this chaos was happening. The first hidden signal we see is a really brilliant hedge. Foreign funds dumped 1.76 trillion won of direct SK Hynix shares. But quietly, on the other side of the trade, they were buying up 89.3 billion won of SK Square. Why? Because SK Square is a holding company that owns about 20% of SK Hynix. So the smart money basically reduced their direct exposure but kept their indirect exposure to AI memory at a holding company discount. They perfectly hedged their bets to capture the future recovery. Pretty clever, right? Hidden signal number 2 reveals a massive countertrade. While foreign institutions and those algorithmic ETFs were busy dumping shares, Korean individual retail investors were stepping up to the plate in a massive way. These retail investors swooped in and scooped up a breathtaking 4.26 trillion won's worth of Samsung and SK Hynix. They basically made a calculated bet. They trusted Alphabet's confirmed billions in purchase commitments for AI infrastructure over the temporary geopolitical noise coming out of the Middle East. They didn't see a fundamental collapse, they just saw a really good discount. And that brings us to our third hidden signal, sector rotation. Remember earlier when we talked about that 10-year yield spiking and increasing the discount rate? Well, that immediately changes the kind of corporate fundamentals that investors want to prioritize. Suddenly, capital rapidly rotated away from future-promised AI tech and straight into companies with confirmed, near-term benefits. For example, Samsung Biologics saw 68.6 billion won in foreign buying because their new manufacturing plants are generating confirmed free cash flow right now in the current quarter. Meanwhile, financials like Samsung Life Insurance caught bids because rising bond yields directly increase the investment returns on an insurer's existing float. Basically, when the discount rate rises, cash flow today completely beats promised cash flow tomorrow. Which finally brings us to the big, provocative question. Seeing all this data, the ETF doom loop, the smart money hedges, the massive retail dip buying, we have to ask ourselves, did geopolitics permanently break the AI memory trade, or did algorithmic overreactions just reprice it for the short term? The fundamental demand for data centers absolutely has not changed, but the cost of capital certainly has. It's a fascinating tension, and it's definitely going to define the market going forward. That is exactly the kind of market tension we track here every single day. If you want to stay ahead of these algorithmic shocks and catch the Asian market close before Wall Street even opens, make sure to hit that subscribe button. Thanks for hanging out, and I'll catch you in the next one.